Good day. Welcome to another session of Fog Accountancy Tutorials. Today we are going to continue our study on the International Financial Reporting Standards. And the topic for today is fair value measurement, which is IFRS 13, fair value measurement. Now, I am sure that in your study of accounting and financial reporting, you have come across a lot of fair value measurement in terms of the preparation of published financial statements for companies, for final account for sole trader, and then maybe for partnerships. You may also have come across it in the preparation of consolidated financial statements and in other areas where we usually talk about fair value of assets, like standards like property, plant and equipment, investment property, have all mentioned fair values in their presentations. Now, I just want you to understand that aside those places where we have used fair value, in the measurement of assets and liabilities, especially assets, we have a separate standard that has been set aside for fair value measurement, and that is IFRS 13, International Financial Reporting Standard number 13. And that is what we are going to delve into today. We are going to look at the pros and cons of this standard and then how to go about the measurement of fair values as prescribed by IFRS 13. And so I'm not going to take much of your time. Just as I do in every standard, I'm going to begin with the scope of the standard, and then I'll talk about some exclusions, which is literally part of the scope, and then we look at the key matters that we need to take note of, and then we solve questions. Okay, so let us begin with the standard. Now, IFRS 13 defines the concept of fair value and sets out the procedure for the measurement of fair values for assets and liabilities. Okay, that is the scope of the standard. It defines what fair value is, and then it gives us a framework for the measurement of fair values for not only assets, but assets, liabilities, and even owner's own equity. Okay, so that is the scope of IFRS 13. So whatever fair value assignment or fair value measurement that we want to do regarding an asset or liability, we need to follow the framework that has been prescribed by IFRS 13. Now, moving on straightforward, now that we know that the main scope or the scope is about the measurement of fair value, not only for assets, but for assets, liabilities, and equity, we need to look at some exclusions, because if we are not careful, once we are saying that we use it for the measurement of fair value, okay, we are going to apply it to all standards and all asset, liabilities, and equity. However, the standard IFRS 13 has excluded certain standards that are excluded from the application of this framework in the measurement of fair values. Okay, so we are going to look at exclusions from IFRS 13. Okay, so exclusions. Exclusion. So we are saying that the scope is that it defines fair value and then sets out a framework for the measurement of the fair values for assets, liabilities, and an entity's own equity. Now, nonetheless, there are some exclusions from IFRS 13, and the exclusions helps us to understand the basic concepts that are in the standard itself, because when you know what it is not, then you understand what it is better. You understand? So let us look at exclusions from IFRS 13. Now, this standard says that IFRS 13 applies to all IFRS where fair value measurement is required, except these that I'm going to mention. It applies to all IFRS. So take note, we are trying to understand the scope with the exclusions. It applies to all IFRS where a fair value measurement is required, with the exception of these three standards. 1, share-based payment. Share-based payment transactions. That is covered by IFRS 2. So you see, normally when we give you the exclusion, we show you which standard regulates the exclusion. That is what we have done in all our videos. Now, so the first exclusion is that we are saying that it applies to all IFRS. All IFRS where fair value measurement is required, with the exception of share-based payment transactions. That is the first one. And then leasing. leasing transactions or lease transactions, and that is covered by IFRS 16. Okay, so it excludes share-based payment transactions. It also excludes the measurement of fair value and leasing transactions. Then it also excludes measurements which are similar to but not the same as fair value. So it excludes fair value measurement and share-based payment transactions. It also excludes fair value measurement and leasing transactions. Then it excludes measurements that are similar to but not the same as fair value. So measurements that are similar to, comma, but not the same as fair value. Now, what do we mean by measurement that are similar but not the same as fair value? I'm going to give you an example. So the standard provides examples to that. So the first example of a measurement that is similar but not the same as fair value is net realizable value of inventory. Net realizable value of inventories, that is covered under IAS 2. Okay, so you see that when you look at a net realizable, how did I even spell realizable? So realizable, yes. So when you look at net realizable NRV of inventories, it looks like a fair value, but it's on its own, and then it's regulated by IAS 2. It looks similar to the way we do the measurement of fair value, but it is not fair value. That is why we are saying measurement that are similar but not the same as fair value. Net realizable value of IAS 2 looks similar to fair value measurement, but it is not fair value. So it's part of the exclusions. And then also value in use as in impairment, IAS 36. Value in use, that is when you are estimating the cash flows of a particular asset into the future, and then you discount them into today's terms to find the present value of the estimated future cash flows. It looks similar to the measurement of fair value, but the standard says it is not fair value. So these are exclusions from IFRS 13. So it means that if you are preparing or you are solving any question on IFRS 13 and then you meet any of these things, it is not supposed to be part. These are exclusions. Share-based payment transactions, we don't do the fair value measurement of share-based payment transactions are excluded from IFRS 13. That of leasing transactions is excluded. The measurements that are similar to but not the same as fair value, like NRV of inventories and then value in use according to IAS 36. So these are exclusions from the scope of IFRS 13. Now, having understood the exclusions from the scope of IFRS 13, let us now begin to define what fair value is, because we are looking at fair value measurement. So what is fair value? For those of you who have studied or watched my video on IAS 16, IAS 36, IAS 40, IAS 38, and all those standards that relate to non-current assets, you realize that we gave some definitions of fair value in there, and it is not me who generated those definitions. Those are definitions that are in those standards for fair value. And we said that fair value is the amount at which the asset will be exchanged between knowledgeable and willing parties in an arm's length transaction. That is how we gave the definition for fair value. The focus of that definition is purely based on assets, because those standards are asset standards. They are standards of assets. So therefore, the definition of fair value in those particular standards is limited only to assets. That is why we said that it is the value at which the assets will be exchanged between knowledgeable and willing parties in an arm's length transaction. Over there, we are focusing on assets only. When it comes to IFRS 13, I said that the scope is not for only assets, but assets and liabilities. Of course, I added equity, but equity is a special kind of liability. I have mentioned it to you before. So we can generally say that IFRS 13 relates to the fair value measurement of not only assets, but assets and liabilities. So if you want to define the fair value under IFRS 13, you are not just going to go by the scope of assets, but it's supposed to be for both assets and liabilities. So there's going to be a slight modification in the way we are going to define fair value under IFRS 13, because in IAS 16 we said that it is the value at which the assets, but in IFRS 13 we are not going to talk about only assets but assets and liabilities. So you need to understand what we are doing. Okay, so then what is fair value as defined by IFRS 13? Now, according to IFRS 13, fair value is the price that will be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. So I'm putting that on your screen. Look at it carefully. Fair value is defined as the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. So I repeat, the price that would be received to sell an asset, that is the first part, or paid to transfer a liability in an orderly transaction between market participants at the measurement date. That is from IFRS 13 paragraph 9. So you see that there is quite a change. Instead of using knowledgeable willing parties, they have used market participants in this definition. Now, the market participants are assumed to be knowledgeable third parties. Okay, so once we say market participants, they are knowledgeable and they are willing. And then we are saying that the price that will be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants, and it's supposed to be at the measurement date. Okay, at the measurement date. So it means that if I put the value on this asset today as 200 cedis, the value may change tomorrow. So tomorrow I have to do a new measurement. So we keep on assessing assets and liabilities for their fair values almost every period. And once we do an assessment, if that asset is not sold today and we want to postpone selling to tomorrow, then what it means is that tomorrow will be a different date. It is not sold on the date of measurement on a different day. So we have to do a new measurement for fair value at the date when we want to sell. That is why the definition highlights on at the measurement date. Okay, so once we move away from the measurement date, we may likely have a different fair value for the asset or the liability. That is what we are trying to say. So let me say again that fair value is defined as the price that is received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. That is the standard definition for fair value under IFRS 13. The price that will be received to sell an asset or paid to transfer a liability, and it should be in an orderly transaction between market participants at the measurement date. All right. Now, having understood or known the definition for fair value, we are going to look at the factors that should be considered in pricing an asset or liability, because we have said that fair value is a price. Okay, is a price. Key emphasis on price. Fair value is a price that would be received to sell an asset or the price that will be paid to transfer a liability. So whether asset or liability, we are focusing on the pricing of the asset or pricing of the liability. And so how do we do the pricing? So we are going to look at the next subtopic as factors to consider in pricing an asset or liability. So let's look at that. Let me clean this. We are looking at factors to consider when pricing an asset or liability. So we are looking at factors to consider when pricing, because before you determine the fair value of an asset, you need to price it. And before you price the asset or liability, there are some factors you need to consider. Okay, there are 3 factors that you need to consider when pricing an asset or liability. And the 3 factors are: 1, the condition of the asset. So the condition of the assets or liability. So you consider its condition, then the location. The location of the asset or liability. Normally, when it comes to location, it's more concerned with assets. It's mostly concerned with assets, because when it comes, though the liability could also have a location, I mean, it's arguable, but we are looking at, you consider the condition of the asset or liability, then you consider the location of the asset. Then also the final thing is you consider the restrictions on its use. Restrictions on use. Okay, so these are the three key factors that you must consider when you want to price any asset. So what is the condition of the asset? Assuming that you want to value your motor vehicle, you look at the condition. Is it still in good shape? Is it brand new? Is it roadworthy? Can it go for 30 kilometers drive, or it has the strength to only go for 10 kilometers? Does it have a strong engine? I mean, you are looking at the condition. So before you put the price tag, assuming you want to sell the asset, before you price it, you look at a lot of things about this condition. So the condition of the asset at the time of pricing is very important. You cannot price an asset that is degraded, deteriorated, depreciated to zero, and you are pricing it as if it's brand new. You can't do that. So before you price any asset, we are looking at how to determine fair value. We are moving for somewhere, okay? But we are saying that before you price any asset or liability, look at the condition of the asset or liability. Then we look at the location. Let's take land, for example. You see that lands that are sold in residential area or in town are more expensive than lands that are sold in the outskirts of the towns, where people usually don't live. When it's going into the forest, lands that are closer to the forest or bush definitely will have a lower pricing than lands that are sold in the middle of the city. You understand? That is what we call the location. So before you even price the asset, you also consider the location of the asset to price it. So we are looking at its conditions, and then we look at the location. So these are tips that are being given to us by IFRS 13 to help us do proper fair value measurement, so that we don't overstate the value of our asset or liability or understate the value of the asset or liability. So we consider the condition of the asset, and then we consider its location. And then finally, we consider the restrictions on use. There are some assets that are restricted in its use. Okay, for example, if you are buying a land in a mining area, and then you are restricted from digging the ground to find the minerals, you can only maybe use it for farming, or you can only use it, build a house and stay. Now, once there is a restriction on the use, even though the land is rich in minerals, the price of that land will be lower than when it is being, or you are being allowed to mine on the land. I mean, it means you are going to discover gold and oil and all that. So once there are restrictions on use, it affects the pricing. If there is no restrictions on the use of whatever assets or liability, it also affects the pricing. So the restrictions could be state laws, okay? Sometimes it happens. So all that we are trying to say is that there are three conditions or factors, that you have to look at when pricing an asset. And the first one is the condition of the asset or liability. The next one is the location. And the final one is the restrictions on use. These are the provisions given to us by IFRS 13 on pricing of your asset or liability. So now that we have been able to do this, let us also look at the approaches for determining the fair value of an asset. So we have looked at the factors to consider when pricing. Now we are looking at the approaches to determining the fair value of an asset or liability. So the approaches to determining the fair value of an asset or liability. So we have looked at the factors to consider when pricing. Now we are looking at the approaches to determining the fair value of an asset or liability. Now, there are three approaches to determining the fair value. So the factors to consider when pricing is different from the approaches to determining the fair value. There are three approaches to determining the fair value of an asset or liability. I'm going to list them and I'm going to explain to you. So the first one is the market approaches. So market approach. And then the second one is the cost approach. And then finally, we look at income approaches or income approach. So these are three different approaches to determining the value of an asset. You can either use the market approach to do that, or you can use the cost approach to do that, or you can use the income approach to do that equally. Now, I'm going to explain each of them to you. When it comes to the market approach, valuations are based on recent sales prices. So valuations are based on recent sales prices. So what am I trying to say or explain? What I'm trying to say is that when you're using the market approach to determine the fair value of your asset or liability, then you are going to consider its recent sales prices. So you go to the market and then you begin to ask, because for example, if this is the asset that you want to value or put a fair value on, you go to the market and you determine recent sales of this same asset. How much are the various retailers and wholesalers selling the asset? Identical assets. So you go there, you realize that okay, they are selling it for 20 cedis. This one sells it for 21. This one sells it for 19 cedis. So you see that when you gather three prices like that on the market, on recent sales prices, one is selling for 19, another selling for 20, another selling for 21. You can find an average and say that okay, the fair value of the asset is 20 cedis or $20. So when you are using the market approach, it means you go to the market and then you use the recent sales prices to do your valuation. So valuations of the assets are based on the recent sales prices. That is when you are using the market approach. Now, if you are using the cost approach, the valuations will be based on its replacement cost. So valuations are based on replacement cost. So in other words, how much will it cost you to replace the asset in your hand? So you hold this asset, okay, or you have a motor vehicle. Now, you are no more going to the market to ask how much they are selling it. No. But the question is now, how much will I have to incur if I want to replace this asset? So if this asset gets spoiled now and I want to replace it, how much cost will I incur? Because when we talk about cost, it is not only about price. Remember that with the market approach, the focus is only on the prices on the market. But when it comes to the cost approach, it is the price plus other components of cost. Remember, you can refer to IAS 16 for components of cost of an asset. Okay, so when it comes to the cost approach, don't think that it is the same as the market approach where we go and take the sales prices on the market and then we find an average of that as the fair value of the asset. When it comes to the cost approach, you are looking at the replacement cost. And when we say replacement cost, it is not only the amount you use in buying back the asset when it gets lost or missing, but it includes other costs like installation, testing, because you may have established the plant, okay, and then it's in use. So if the plant is no more there, how much cost will you incur in buying, installing, testing, and making sure that it's fit for purpose? That is the replacement cost. So when you are using the cost approach, then it means that valuation will be based totally on the replacement cost. Please, I don't want you to be confused. I want you to understand how we can use the cost approach to determine the fair value of an asset. And then finally, the income approach. How do we use the income approach to determine the fair value of an asset? Remember that an organization can use any of them. It's not obliged that you should use all three, but you can just adapt to one of them. That is, the standard has provided these three as alternatives. So you can choose any of the approaches to fair value your asset. Now, the income approach. With the income approach, the valuation is based on financial forecast. Valuations are based on financial forecast. So you look at how much money the asset is going to generate for you in the end, or by the end of its useful life. So if you have 10 more years to use the asset, you can do a financial estimate of annual cash flows that is going to be generated by the asset, and then based on that you can discount it like the value in use, and then you use that as the income approach. So the income approach is based on financial forecast. Fair value measurements are based on financial forecast. That is the income approach. So these are three approaches to determining the fair value of an asset or liability. You can use the market approach, the cost approach, or the income approach. I am sure this is very understandable up to this point. Okay. Now, what we are going to do is that we are going to define what an active market is and what is an active market, and then we'll look at the measurement of fair value in practice before we look at the question. We are going to zoom into the practical measurement of fair value. Okay, measurement of fair value itself, where we are going to look at the level 1, level 2, level 3 input. But before that, let us define an active market. Once we are able to define an active market, it will help us in the measurements that we are going to do. So what is an active market? What is an active market? You can see that on your screen. An active market is a market in which transactions for the asset or liability take place with sufficient frequency and volume to provide pricing information on an ongoing basis. I repeat, an active market is a market in which transactions for the asset or liability take place with sufficient frequency and volume to provide pricing information on an ongoing basis. So what we are trying to say is that before we call a market an active market, then there is a high frequency or an acceptable level of frequency of similar transactions of the sale of the asset or liability. And not only about the frequency, but the volume as well. Sufficient frequency and sufficient volume. So, I mean, there are goods on the market, and then it also happens on a regular basis. The sale of the asset and the purchase of the asset is ongoing on the market. We call it an active market because it is easier to determine the pricing average always on the market. Once that the sale of the asset or liability is ongoing on the market at a sufficient frequency and volume, then it provides pricing information all the time on an ongoing basis. That is what an active market is all about. Let me read it again for you, and then we zoom into the practical measurement. Now, an active market is a market in which transactions for the asset or liability takes place with sufficient frequency and volume to provide pricing information on an ongoing basis. So this is an active market. Now, we are moving to measurement of fair value itself. You see, the topic is fair value measurement, or that is the name of the standard. We have so far been able to define what fair value is. We have looked at the scope and the exclusions. We have looked at factors to consider when pricing. And then we have looked at the approaches to measurement of fair value. Now we are going to look at the measurement itself, the practical measurement of fair value, and then what some things that you need to consider in the measurement of fair value. Remember that for almost all the standards that we have done relating to assets and liabilities, we have looked at recognition criteria and the measurement criteria. Here, what we are going to look at is the measurement criteria for fair value. So measurement. Or let me say practical measurement. I'm just adding the practical, though it's not in the standard, but I am trying to let you understand what I mean. Because please pay attention. What I'm going to teach you here is what we are going to use to solve the question. And almost all the questions that come under fair value measurement will test you on this. Okay, so please pay attention. Now, from what we have studied so far, I'm sure you understand that fair value measurement is more of a market-based measurement, not necessarily an entity's own intuition or guesswork to put the value of an asset. It's market centered. Okay, from all that we have done, is because even if it's not the market approach you are using, the cost approach has an element of market because you still need a pricing. Okay, and the income based approach is also having some market element because you sell to the market before you generate the income. So the fair value measurement itself is market based, and therefore we try to use more of the observable input in putting in valuation of the assets rather than the unobservable ones. Now we have observable input and we have unobservable input. When we say observable inputs, we can look at the pricing and then the value of the assets for similar assets and all that. I'm coming there. And then we have unobservable inputs. Now, to make it easier, IFRS 13 has established a hierarchical order, or you call it a scale of preference, for putting or determining the fair value of an asset or liability. And so they have established it as level 1, level 2, level 3. So I'm going to explain to you. It's very critical and it's very technical as well. And so I'm going to write the levels, but I'm going to also put them on your screens. We read what goes into each level. We discuss to understand before we solve a question. So that when we are solving a question, it will be easier for you to determine whether this statement is from level 1 or that statement is from level 2 or from level 3. Now, they have established a hierarchical order. So we have level 1 inputs, and then we have level 2 inputs, and then we have level 3 inputs. Now, I have spaced them because when I need to write something related to them, I'll put them down for you to see. But I'm going to still put them on the screen so that we all look at it. I cannot write everything here, but we need to all read together so that we understand what they are trying to mean. Now, these are 3 levels: level 1 input, level 2 input, and level 3 input. When we are doing measurement of fair value, according to the standard scale of preference, it means that preference must be given to level 1 input. When level 1 inputs are not there, then we value the asset or liability based on level 2 input. When level 2 inputs are not present, before we can opt for level 3. In other words, level 3 input should never be used except there is no level 1 and level 2 input. I hope you are getting. You don't know the content of the levels yet. I'm going to show you, but I want you to get this first. That level 3 inputs can only be used to fair value an asset or liability when there are no level 1 or level 2 inputs available. Now, level 2 inputs can only be used when there is no level 1. Whenever there is a level 1 input, we always rely on the level 1 input and ignore the 2 and 3 input, even when they are available. This is a scale of preference. And that is what has been established by IFRS 13. And this is the technical aspect that most of us do not understand. That is why we are not able to solve questions of IFRS 13. Now, when it comes to level 1 input, we are looking at observable. I told you that IFRS 13 is a market-based approach, IFRS 13 is a market-centered approach. Therefore, what it's trying to mean is that we should focus more on the observable inputs and then move away from unobservable. The level 3 inputs are purely unobservable. I'm going to show you. Level 1 and level 2 are observable. Level 3 is unobservable. So let me just give you a hint that these ones are observable inputs. This is also mostly or largely observable. But this one is unobservable. Now, I want you to take note. Now, even though the first 2 are observable, I've said that priority is given to observable inputs than the unobservable ones. Even though both are observable, however, this one is observable in an active market. So let us know, before I explain, I think you are not getting me. So let's read what the provisions are in the standard. From there, I'll come back to explain to you. So let's come to what is here. Now, so as you can see on your screen, there are 3 levels for the measurement. Level 1 inputs are quoted prices in active market for identical assets or liabilities that the entity can assess at the measurement date. Now, these quoted prices are unadjusted, unadjusted quoted prices in active market for identical assets and liabilities that the entity can access at the measurement date. The level 1 input is about quoted prices. So if you want to price or find the fair value of this asset, you go to the market and find the quoted price of an identical. When we say identical asset, it means that it is the same type, the same brand, the same quality, everything is the same. So you go to the market and you find the quoted price unadjusted. So when we say unadjusted quoted prices, we are trying to say that these prices are not adjusted based on the seller's preference, but these are the prices that are fair, that is supposed to be used, or the standard price for all the identical assets. So unadjusted quoted prices of identical assets in an active market. So in this case, if the market is not an active one, then it will not be under level 1 input. So before you call level 1 input an asset a level 1 input, or you want to price or fair value your asset based on level 1, then it means that you should get an identical asset in an active market, and you find the price, unadjusted quoted price of an identical asset in an active market. In an active market. So even if it's an identical asset but not in an active market, it will come down to level 2. So the key thing is that there should be the quoted price unadjusted of an identical asset, not a similar. There is a difference between identical assets and a similar asset. Identical asset means everything is the same, including quality. A similar asset means that it looks like, but they are not the same. Okay, so here we are not talking about similar assets, because similar assets will come down to level 2. So level 1 inputs are quoted prices of identical assets in an active market, and the prices should not be adjusted. So let us go back to the screen and read this. Level 1 input, quoted prices unadjusted in active market for identical assets or liabilities that the entity can access at the measurement date. So these should be assets that the entity can get hold of today if they want. It's not imaginary. So that when you say quoted price of an identical asset in an active market, today, if I want to go and buy it from the market, I can access it. That is what we mean by level 1 input. Now, it will make sense as we go on. Don't worry. Let's look at level 2 input. Level 2 input, look at what the standard is saying. Inputs other than quoted prices included within level 1 that are observable, so it's also observable, for the asset or liability, either directly, that is in pricing, or indirectly derived from the pricing. This may include, so they are making it clear, this may include 1, quoted prices for similar assets in active market. So you see that quoted price for identical asset in an active market is a level 1 input. But quoted asset for similar prices, similar. So here we have quoted price for identical assets in an active market. The same thing comes here, but this time it is the quoted price of a similar asset also in an active market. So there is a difference between identical asset and similar asset, both in an active market. So when it comes to level 1, it should be the quoted price that is unadjusted of an identical asset in an active market. When it comes to level 2, it's also observable quoted price of a similar asset also in an active. We are not yet in an inactive market. We are still in an active market. However, the only thing that is changing here is that level 1 has to be an identical asset. Level 2 has to be a similar asset. They are not the same. Now let's look at the next one. So we have quoted prices of similar assets in an active market. Then quoted price for identical assets in less active market. So you see that aside that the quoted price of a similar asset in an active market comes to level 2, we also have quoted price of the same identical asset but now in a less active market. So when the assets are identical and the prices are quoted. Please, when you are reading the question, you need to be very careful because we are going to use this to advise company. Now, if the quoted price of the identical asset is in an active market, it's a level 1 input. If it is in an inactive or a less active market, it comes to level 2. So we have quoted price of an identical asset in a less active market. So this time around, it is identical, not similar, but the only change is that level 1 is an active market, level 2 is a less active or inactive market. It will make sense when we are solving the question after this. After this, you are solving a question, you understand. Then we look at the third one. This one is also observable, observable input that are not prices, such as interest rate. So here I told you that everything here is observable. Everything level 2 is also observable. Level 1 is observable, level 2 is also observable. Here we are saying that observable inputs that are not prices, for example, interest rates, exchange rates. There are so many things that could affect pricing of an asset on the market. Most of them are economic factors. So observable inputs that are not prices. So you could see that all that we have already written are prices. This is a price. This is also price of similar asset. This is also price of identical. Everything we have looked at is about price. The first time we are coming to something that is not price is the third point under the level 2 input. Observable inputs that are not prices. For example, interest rates. So those ones also affect the price of a market asset or liability. So this is a level 1 input. These are level 2 inputs. When the question comes, you'll be able to identify when to look at level 1 and level 2. Now let's come to level 3 input, which is the final one. Here, the key word is that it is unobservable. So, and we have said that the general rule is that we should focus more on the observable ones and pay less attention to the unobservable, except the observable ones are not available. So here, the key word is that it's unobservable. So let's read. Unobservable input for the asset or liability. Example, discounting estimates of future cash flows. So level 3 inputs are only used when relevant observable inputs are not available or where the entity determines that transactions price or quoted prices does not represent fair value. So we are saying that we only use the level 3 input when prices do not reflect fair values. Other than that, we always have to give preference to. And this one, we are saying that it's unobservable input. And they give the standard give us an example of forecast future flows or forecast cash flows. So value in use can be used there. So, I mean, these are 3 levels. Now, I'm going to solve a question with you right now. And then it will help us to understand these 3 levels of input very well on how to do valuation for your fair value. So what we are going to do now is that we are going to take a very simple question that will introduce our understanding on this. Okay, so we solve that, and then afterwards I'll introduce other concepts in the part 2, and then we'll solve complex questions. So this is a very simple question that is testing our knowledge on the levels of input for measurement. So let's begin. Dakra Limited has an investment property that is measured at fair value. This property is rented out on short-term lease. The directors wish to fair value the property by estimating the present value of the net cash flows that the property will generate for Dakra Limited. They argue that this best reflects the way in which the building will generate economic benefits for Dakra Limited. The building is unique, although there have been many sales of similar buildings in the local area. required. Discuss whether the valuation technique suggested by the directors complies with international financial reporting standards. Now, this is a very simple but tricky question. We are testing our knowledge on the levels of input, and we are saying, remember that we have said that to value any asset or liability, you need to give preference to level 1 input. When level 1 inputs are not available, then you move to level 2 input. When level 2 inputs are not available, before you consider level 3. Now, going back to the question, we are told that Accra has an investment property that is measured at fair value. This property is rented out on short-term leases. So that is introduction. Now, this next point is important. The directors wish to fair value the property by estimating the present value of the net cash flows that the property will generate for Accra Limited. So they want to fair value this asset by estimating the present value of the net cash flows. What level of input is this? This is a level 3 input. This is an unobservable. You cannot observe. It is just an estimate. You don't know how the future cash flows will be. And we are saying that that is a level 3 input. Anytime they try to estimate a forecast of future cash flows, like we said, it's a level 3 input. And so they can only do that when level 1 and level 2 inputs are not available. But are they not really available? Let's continue to read. So that is what they have chosen. And your job is to advise the company. So you need to explain to the company, and that is normally how these standards questions are given. Now let's continue reading. They argue that this best reflects the way in which the building will generate economic benefits for Accra Limited. So you see the argument. The last sentence is very important. I'm going to show you two important things from the last sentence here. Now, the building is unique, although there have been, let me pause there. The building is unique. Now, listen carefully. When we say the building is unique, it means there are no identical buildings anywhere. And remember that for level 1 input, there should be identical buildings that have quoted prices that are unadjusted. But once the question says the building is unique, it means there are no identical assets anywhere. Or anywhere close to where we are. And once there are no identical assets, it means there are no level 1 input here. There is no level 1 input. Take note. Look at what they are saying. The building is unique. And once the building, so here you need to really understand that once you see a unique building, if there are identical ones on an active market, then it's not unique. So the moment you are told that the building is unique, it means there are no identical buildings in the active market. So level 1 input is out now. Now, remember that the directors are proposing to use a level 3 input as a means of doing the valuation, but we don't have a level 1 input now. Do we have a level 2? If we don't have a level 2, they are justified. But if we have a level 2, then we need to switch and advise them. So let's continue reading again. The building is unique, although there have been many sales of similar buildings in the local area. There have been sales of similar buildings. The sale of similar buildings is what? A level 2 input. So we need to now go and find the price that was used to sell those similar. Remember that I've told you from what I explained that there is a difference between identical and similar. Identical is a level 1 input. Similar is a level 2 input. So therefore, once there is a level 2 input, how are you going to advise the directors? So you start your write-up by saying that because the building is unique, please don't just say they should use level 2 because they are similar. You need to build your point. This is a standard question, I've told you. So you need to write English. So you start by saying that because the building is unique in your exam or answer booklet when you are writing the exam. Because the building is unique, it means that there are no identical buildings on the market. Therefore, level 1 inputs are absent. Then, because there are similar buildings on the market, it means that there are level 2 inputs present. And therefore, the company or the directors can go and find prices of the similar buildings that were sold, and then use that price as a valuation. Now, the alternative that I'm showing you how to write your answer. The alternative that has been adopted by the directors is level 3 input. That is the forecasting of the cash flows. And according to IFRS 13, level 3 inputs can only be used when there is no level 1 or level 2 input. So therefore, because there are level 2 inputs in this question or present, then you advise the director to switch or move away from using the forecast cash flows, but rather using the prices of similar buildings that have been sold to do the fair value measurement. And then you can conclude. That is how you write your answer for this. The question looks very small, but you need to touch on everything. So when you get a question, my advice is that whether there are level 1 or not, or level 2 or whatever, you need to touch on every level. If there are no level 1, write that there are no level 1. And what should have been the case if there was level 1? So indirectly, you are writing the rules. If there is no level 2 input, write. And what you think should have been if there was. If there is, you show. If there is level 3, you tell us why they cannot use or why they can use. Because you are always standing in an advisory position when it comes to fair value measurement. I hope you understand this very well. Okay, so this will bring us to the end of part 1 of our video on IFRS 13. In the part 2, we are going to look at other concepts like principal markets, advantageous markets, and then we'll solve a question relating to that, and then we'll come back and then now solve other complex questions relating to IFRS 13. Remember to subscribe to this channel if this is your first time. Share this video and let others also have a benefit. And until we meet again for the part 2, is bye for now. Thank you.